The best performing consumer staples stock ever returned 12 million%. That means $1 invested would have turned into $123,000. That's the 9th best performing stock ever. You're dying to know which stock it is, aren't you? Well, hold your horses there, Tonto. I'll tell you about the stock in a second. But first, a story. One of my biggest passions isn't climbing corporate ladders or collecting degrees like merit badges. It's having adventures. I've been to more than 2/3 of the world's countries, including places like Yemen, Iraq, Somalia, and North Korea. And you know what I found most remarkable about the Hermit Kingdom? It wasn't the cute traffic girls, the empty roads, or the friendly soldiers. It was the fact that Coca-Cola, a defining American brand, can even be found in the DPRK. Now, I took this photo at a pizza shop in Pyongyang, and that wasn't their only Coke product. They also had Sprite, too. So just some knee-jerk thoughts on Coca-Cola, at least what I think when I hear that name. Isn't that a company Warren Buffett invested in? Isn't all their growth behind them? How many cans of Coke can people possibly drink? Coke is certainly being threatened by new emerging brands. There's probably not much growth left in the stock. Well, Coke seems to have a plan for all that, and what you need to remember when you think about Coca-Cola is that it's more than just the drink Coca-Cola. So the last time I tried to find this picture up here on top of the most recent collection they have of billion-dollar brands. Here's 21 of them, and they're now 26. What's interesting is that they have around 200 brands that are sold in 200 countries and territories. There's officially 194 countries, so they also include territories. But that's a 50% reduction between 2019 and 2022. So they used to have around 400 brands. So they're really scaling back so they can focus, and they sort of group their brands into buckets you see here. So they have the traditional sparkling soft drinks, Coke as you know it. Then they have their juice and dairy, and then there's water, sports, coffee, tea, and emerging. So they're looking at doing new things, which is great. Now, when we look at the growth of the company, it's not overly impressive. So you can see they've had a bit of a turnaround recently. And the times of the Rona, they weren't doing so well there, or they weren't doing well even before then. But now they're starting to see, at least in the past 3 years, some sort of trajectory of revenue growth. And the way they explain that is through this diagram, which shows developed markets, and they say developing and emerging. We usually call those just emerging markets. So in developed markets, such as the United States, nearly 90% of the population drinks commercial beverages, yet only about 30% of them drink a Coca-Cola product at least once per week. So they want to convert those people. You see there what they refer to as the Coca-Cola company customer there in red. Each red figure represents 10 million people. And the gray, these are people they want to drink Coke once per week. And the people in the light green there, those are individuals that don't drink any commercial beverages. So there's a lot of potential market in emerging markets where 80% of the population doesn't consume any commercial beverages. And the Coca-Cola investor deck has this great slide for each of their regions. So here you can see North America. The total addressable market is $380 billion. You see that broken down there on the left. Then when you look on the right, this is really smooth. It shows the industry compound annual growth rate for each one of those segments. And then it shows their share. So that's really impressive. They have 50% share in sparkling soft drinks. Then it shows whether they gained or lost share. So you can see on energy drinks, they have a plus 2%. Coke has a 40% market share in energy drinks. The Celsius folks ought to pay attention to that. Coke can act very fast when it comes to marketing and competing against smaller players. Water, sports, and tea, you see there, they lost 100 basis points. So they do that for every region. You see here's APAC, $500 billion TAM. So they have, over $1 trillion in total addressable market. But interestingly, in Asia, hot beverages make up a lot of the total addressable market. You see they have less than 5% market share, and that's also growing decent, mid-single digits there. So when we look at the revenue segments for Coke, you see on the left there that pie chart shows around $46 billion in net revenues for 2023. And I wanted to point to a couple things. So you have two pie charts here, revenues and income. So you see for bottling investments, that accounts for 17% of revenues, but only 4% of their profits. So they've actually reduced their exposure to bottling significantly from 52% in 2015 to 17% last year. and they're moving away from that as part of their overall strategy. Then look at LATAM, or Latin America, 12% of revenues, but 22% of profit. So when we think about a growth stock, we'll typically look at revenues to see what exposure they have. When it comes to a value stock like Coca-Cola, we'll look at operating income or profitability. And when we chart that over time, you see here on the left, there's some consistency, but what about 2017? So I asked Google, it didn't tell me anything useful. And then Perplexity told me here something interesting. So they refer to a one-time net charge of $3.6 billion resulting from the U.S. Tax Cut and Jobs Act. That was a one-time event. And then refranchising their bottling operations. That's what they've been doing because they're not so profitable as we saw, right? Now, when you're thinking about their ability to keep growing that dividend over time, they're a dividend champion. We're going to talk about that. But what you can do is look at how well their free cash flow. So that's money the business is generating after they've spent money on things like capital expenditures, trying to reinvest in the business. Here's how much cash they have, and there's their dividend payment. So they're handily covering that, at least in 2018. They weren't quite able to, but then they're able to in the following years there. So I really like this slide. It shows the CapEx. So you see the chart on the upper left there. That's reinvestment in the business, capital expenditures. That's the cash generated from operations, right? And then they invest in the business. Then they have money left over. What they can do with that is either pay a dividend or buy back shares. And you see they're doing both of those activities. Of course, they've paid a dividend for a long time now. But I wanted to point here to something rather interesting. It's their $8 billion brands added via acquisition. I think this might be over the last decade or so. And there's some interesting names. And their Topo Chico has certainly made an entrance. And what you see here, they're generating proceeds from the sales of bottling investments, reinvesting that back into acquiring growth. And they say they want to have 4 to 6% organic revenues, 6 to 8% operating income growth, and then 7 to 9% earnings per share growth. Why is that higher? Well, that's because they're buying back shares, reducing the number of shares. So that's a clever way to increase earnings per share, right? So then when we look at what the company is going to do in the face of all this new AI technology that's coming out, we did this piece, this would have been 6 years ago, coming up on 6. We said here the only way Coca-Cola will continue increasing profits so that they can increase those dividend payments for another 55 years is by using technology like AI, not by engaging with the Tillys of the world. So in that piece, we looked at how they were doing a social media reach out, and it was an absolute disaster, a waste of shareholder value. And essentially, they seem to really have turned that around. So you see here, digital spend as a percent of total media. So they're really focused on that. That's the future, of course. You see here, pioneering with AI, creating engaging brand experiences and such. And when you look at the potential they have for growth, it isn't just coming up with new things to drink. You see they're talking here about different packaging solutions, equipment. So they have a machine that can actually mix drinks on the fly. So there's a lot that they can do to innovate. And when we think about why we're holding Coca-Cola, it's not because they're the 9th best performing stock ever. Here you can see on this table, we did a recent piece on the top performing stocks ever. These are the top 10 best performing stocks by annualized return. And Coke there is in 9th place. That's not why we hold it. We hold it because it's a dividend champion. And Coca-Cola has, this is important, not only paid, but increased their dividend for over 60 years in a row. That's a remarkable track record. Here you can see the most recent, 8 years or so. Their increase has been not very significant. The table on the left shows their 5-year growth rates, barely outpacing inflation, I suppose. 10-year growth rate a bit better at 5%. But their yield, of course, too, rather, one might say low at 2.78%, but that's because the stock's been running up lately. And this stock doesn't move very quickly. It has a beta of 0.61. That means it's actually less volatile than the overall market. So when we thought about whether to hold Coke or Pepsi, because we wanted to, this company actually has a high Q score. Here you can see our new Q score calculator, and we simply filtered on consumer defensive core, and there you see in top positions Procter & Gamble and then Coke and Pepsi. You see Coke and Pepsi really running head to head there. A lot of similar metrics. Coke has a slightly higher Q score, but essentially it's a toss-up. You pick one. Pepsi's growing their dividend faster. Coke has stronger international sales. Pepsi sells snack foods. I mean, you can go through, and actually, if you're interested in learning more about these two companies, you can watch this next piece on Pepsi versus Coca-Cola. Thanks so much for taking the time to watch this today.